Hello, this is Steve Coker, and welcome to the Cedarstone Advisors Economic Insights for March of 2015. The goal of this webinar is to provide a sample of some of the more critical economic factors that we are tracking here at Cedarstone. For March, we'll be focusing on the recent drop in oil price, the corresponding drop in U.S. rig counts, the implications for stocks, and in particular, oil and gas stocks. So, first, let's look at the trend in oil prices so we can see what we're going to be talking about here. This chart shows the price of oil from June of 1986 through January of 2015. And you can see what appears to be a dramatic drop in prices beginning in June of 2014 in the midst of increasing oversupply. However, a key takeaway from this chart is that a 50% drop in oil prices is not unprecedented. We have seen it in 2008, 2001, and also back in 1991, as shown by the grayed out sections of the chart. In each case, oil production and oil demand reached an equilibrium and oil prices did recover. However, this decline in prices is somewhat different in that it is caused by an oversupply of oil rather than a drop in demand as in 2008 and 2001. What do I mean by oversupply? Let's dig into the numbers. This chart shows world crude oil supply versus consumption. Supply is shown by the solid red line on this chart, and demand is shown by the dotted red line on this chart. Oil prices are shown by the black line on this chart. And so we can see as we track supply versus demand that they are very closely correlated and are matched over this time period until we get to about 2014. And beginning in 2014, there's a persistent oversupply. And as a result, you can see that the price of oil has declined in the last part of 2014. Well, if it is a supply problem, why the oversupply? This next chart digs into world crude oil production for non-OPEC versus OPEC producing nations. And we can see that it's not OPEC. It's actually the non-OPEC producers that have increased production. And if we drill even deeper still, it's not Europe or Russia or China. It is the United States that has increased production dramatically over the last 4 years and caused this oversupply of oil. OPEC, by contrast, in total has been flat, but has also shown increases by Iran, Iraq, and Libya. And it's Saudi Arabia that has cut slightly to make up for their oversupply. So in summary, what we can see is that the United States is really the cause of global oversupply, increasing production by 56% over the last 4 years, and that Saudi Arabia has borne the brunt of the production cuts thus far. But what they're saying at this point is that they're not going to take it anymore. They're not going to allow others to increase production while they reduce production and lose market share globally. If it is the United States that is the cause of the oversupply, we should dig into U.S. production. One of the unique things about U.S. production, and it is driven by technology. It is the shale production that is causing the increase in production. And shale requires a significant number of rigs. It requires continuous drilling in order to maintain supply. In 2015, we've seen a dramatic drop in U.S. rig count. The implications being that U.S. production should begin to drop as fewer wells are being put into place in the United States. This is expected because at around $50 a barrel, it no longer becomes economical to drill for shale in the United States. This is an article from the Wall Street Journal quoting a ConocoPhillips economist predicting that at $50 a barrel, that would really start to harm production because it just doesn't make sense economically. If that is the case, then we would expect oil prices to begin to form a bottom around $50 a barrel because that's the point at which the U.S. will begin to significantly cut production, and that is exactly what we're seeing. This chart shows, again, the price of oil, here shown in red, against oil and gas stocks, shown by the SPDR Energy Select Sector ETF and the iShares Oil and Gas Exploration ETF. And you can see that at the beginning of 2015, oil and gas, as well as oil, are showing a fairly convincing bottom in terms of their prices. If we compare that to what analysts are saying, basically, here's a great article from an analyst that was tracking Southwestern Energy, and clearly this analyst just blew the call. In June of 2014, the analyst showed an outperform for Southwest Energy. November 25th showed an outperform despite the recent drop in price. And then in January of 2015, when a bottom seemed to be forming, changed to an underperform for Southwest Energy. Again, it speaks to the reason that at Cedarstone Advisors, we don't believe in market timing. Certainly take all of these analysts with a grain of salt, but do believe in fundamental indexing, which has taken advantage of the decline in oil and gas stocks, rebalancing into that weakness, and as a result, showing some significant outperformance here in February. If you'd like to learn more about Cedarstone Advisors, learn more about fundamental indexing, or would like to just give us some feedback on this webinar, we would appreciate hearing from you. Thank you so much.